launch into a little bit of a quick review on what we did last week. And so let's kind of go through that, and then we've got a group of 4 different advisors that all kind of do very different things. And a lot of times as people look at their portfolios and they go out for the selection process, as we've walked you through the goals, the allocation, the selection, and now the next step is, okay, if I'm going to hire somebody, what does that look like and what kind of questions do I ask? So right here tonight, we're going to give a little bit of insight. We're going to interview 4 different guys that represent 4 spectrums in this particular world. So last week it was this active to passive scenario, and Peter Lynch, who is one of the more famous active managers, talks about not being able to have much of an advantage over the passive guys. It's interesting. And then Warren Buffett, he talks about his view of what he'd like his heirs to, how they would like to invest their capital. And he says 90% index, 10% cash. So you have it from kind of the 2 smartest guys out there. And the reality of it is on the active side, it just costs more. And so fees can be a massive erosion of investment performance. And even with you paying more, there's really no guarantee that you're going to get market-like representation. And if you look at the different ways that people view markets and time markets and make different moves, man, I mean, this cycle couldn't have been more dramatic in terms of going down 34% in literally a matter of 23, 24 days, and then all of a sudden turning on a dime, and we're close to market highs. The S&P is positive for the year. The NASDAQ has made a new high. So what was left on the table through these various strategies? So we showed you this last week in the large cap space, very difficult to outperform the index. Small cap, some of the smaller areas of the market, active managers do a better job. So it's not kind of one size fits all. We definitely say, okay, now who wins in this argument? Who wins in the active passive debate? Well, it just kind of depends. So it's maybe not index every category. Maybe it's you hire an active manager in some of the smaller, what are called satellite categories. That would be small emerging markets, things where there's less efficiency. When people look at selection, everybody thinks and talks about performance. What have you done? What has been your track record? What'd you do the last 5 years? What'd you do the last 10 years? And what we know about that is that's not an accurate representation of whether or not that skill can be repeated on a going forward basis. So last week we just got you familiar with beta, which measures the contribution of the market, the speed of the river. R squared shows you correlation between the manager and the index. See, we want to make sure that we're comparing apples and apples. We're comparing a large cap manager to a large cap segment, a small cap manager with a small cap benchmark. And then alpha is really what we strive for. It's the additional return that comes over and above the market. It's why you would pay an additional fee, because you want to get the alpha. And then Sharpe ratio is just a risk-adjusted measure that shows you how much return do you get for an incremental level of risk. And then we brought our speaker, Phil, who really was amazing, talked about ESG, which is environmental, social, and governance, and it's really a hot topic in today's world about how do you align your values? How do you align your values and your mission with your investing strategy? And so there's just going to be so much that is going to be publicized, talked about. There's index funds that are that screen for ESG. There's active managers that screen for ESG. So it is really just getting started in the last 4, 5, 6 years around this particular topic. Environmental and social has been around much longer, but it's taking on a different form, and it has just a different level of momentum. This chart here just kind of talks about the screening tool and laggards versus average versus leaders. Morningstar.com is a great tool. They have a screening mechanism where you can put your fund in, and it can show you what's there. And then really tonight is it's really two things. It's two elements. It's how do you implement? So once we've identified asset allocation and managers, then you then look at, okay, what do I have? So is there a difference between what my current situation is versus what the optimal situation is? And so then what does that mean? When and how do you do that? So then it's like, okay, how do you view that? How do you deploy, and how do you move, and when do you move from what is optimal versus what you currently have? And that's really tonight. And then we look at how do you choose the right advisor? And again, we have 4. And so because I'm in this community, I know really the top guys. And so I've really brought in a group that's going to give you their flavor of how they see the investment world, what their process is, and what their various levels of expertise and the kind of clients that they service. So when you look at implementing, when people look at I got to change from what I currently have to what is more optimal, there's always a tax cost to that. So we see that especially in a concentration. We see that in a rebalancing. And one of the biggest mistakes people make is they say, well, I can't pay the tax. I can't afford that. Since when is tax 100%? A lot of mistakes are made here in this area. And then there's the opportunity. Saw this a lot. I started teaching this class in '99, and we were doing a program in Silicon Valley in 2000. And we had a lot of young people that came in with tremendous wealth in technology companies that had started to go down in the tech correction of 2000 and 2002. And so what their view was like, wait a minute, my stock was 80 and now it's 60 and I can't sell. And so they got the goal part of all of this backwards. And so they looked at the opportunity and said, well, I'll sell when it goes back to 80, not 60, because I don't want to leave money on the table. So you have a lot of that. You got to be super clear about what the objective is, what the goal is. How much money do you need in a lifeboat? How much income you need, regardless of whether or not you're working. One of the things that we really tried to do with those young 30 to 30, 40-year-olds that all of a sudden had phenomenal wealth that was really just all on paper concentrated in one individual stock. You tried to stop them to say, listen, if you sell X portion of that stock and you bank, you'll never have to worry about money again. It's called that lifeboat money. So we really worked hard at separating the opportunity from the goal. Sometimes we were successful and people really got that. Other times they really had this belief that their stock was the end all to be all, and it would go back to those higher levels. And what we saw in the technology correction over the next couple of years, that in many situations that didn't happen. So you have this conversation about target versus actual, and there's always a cost to do this. There's always a time to rebalance, and this is one of the questions I'm going to ask to the advisors to come up is when to do this and how to pay the tax, and what are some strategies around really when do I rebalance. Biggest mistake that we see in the wealth management, or one of the biggest mistakes, is just in concentration. When you own one thing, one stock, wealth is created in a dramatic fashion. But if something ever happens to that stock and you own the wrong stock, then all of a sudden all of that wealth and all of that freedom vanishes unnecessarily. And so concentration is always a difficult place to come from. So you always got to go back to what is your mission, what is your values, and what is your goals, because what is more important, a stock going from 50 to 80, or you fulfilling on what your life's dreams are in and around the things that you want to do. We had one amazing example where it was a bank stock, and the stock had gone from 60 to 30, and we did an analysis, and we basically figured out that they could sell the stock, pay all the taxes, and be completely financially free. However, there was that winner mentality that was constantly scratching. They said, okay, I get it. However, I'm not going to wait for it to go to 60. I'm going to wait for it to go to 40. It's at 30, and 40 is right around the corner. So let's get to there, and then we will rebalance. Well, it never went there. It never went to 40. Maybe went to 32, 33, and then went to 10. So that all of a sudden triggered all kinds of different emotions, because we're littered, we're filled with this optimistic view. And so they just didn't get it. And so we bring this up that it's just one of those things because emotion enters into the equation. The opportunity, what happens if you double your money, and what happens to what you do and how you do it. The goal is the goal. And then here is that emotional side of just the fear of missing out. If something, goes up. I was talking to a guy on the phone today, and he brought up there was a local company that makes hydrogen trucks that hasn't made a truck yet. And he bought it at 12, and now it's 90. Nikolai is the company. He's like, I'm not selling it because I just think it's going to continue to go up. So anyway, I mean, it's really what the first and foremost, goals drive investment decisions. The opportunity doesn't drive the goal. That speaks to that here. So really what we're going to rifle through here in the momentum is, when is the time? How do you make these various calls around what you do and when you do it? So I'm going to just talk about a quick, case study versus what if you had a lump sum amount of money, what would you do? Would you dollar cost average or were you lump sum? So really two separate discussions here. One is the first one we had, you have a target allocation and then you have an actual. When do you do that? And what's the cost associated with that particular rebalance? Now the second piece is you just got a windfall. What do you do? The market's up. It's near highs. Everybody says, maybe not. Round 2 of COVID might be, after the summer. So do you wait? Well, let's talk about this. Well, one of the things is you got 500,000. Let's just use a round number. And I don't know if you remember this, but you can go back and look at the replay. The gentleman that introduced me in the program, Mike Mackin, sold his business in 07 and invested at the beginning of 08. Couldn't have been a worse time. But he adopted the strategies, not that they were my opinions, he just adopted a value goal-based type of an allocation that was rule-based. So when different parts of the market went down, he just rebalanced into those various asset categories. So he followed the plan. It was what was interesting about Mike, and people ask me all the time, it's like, okay, can you talk to me about somebody in the class that has followed what they've done? Well, we don't follow everybody. But what happens is Mike was smart enough to know that he didn't know. And so he came into the class as a guy that was thirsty for education but had done a lot of reading and done a lot of analysis, and that really hadn't translated to comfort for him. So when we mapped this out, he just knew that he didn't know that markets cycle in such a way that he needed to have these rebalancing mechanisms in place to where they would just make the decisions for him and remove him out of the emotional equation. So when you get into dollar cost averaging, let's just take a couple and say, okay, 500,000, what should they do? Should they invest all at the same time? Should they average a little bit of time? But then again, how long should they take to invest that money? Should it be 6 months? Should it be a year? Should it be 2 years? We've had many people that have come to our class that are sitting on a wad of cash that tell me that they're going to invest when the next correction happens. That's tough because that correction typically doesn't happen, and when it happens and the markets go lower, they think it's going to go lower, so therefore they wait. So we have really three kinds of markets. We have a market that steadily declines. We have a range-bound market that just kind of goes up and down. And then we have an increasing market. So if we look at the data, and you look at the 500,000, we look at dollar cost averaging on the left, lump sum investing on the right. And you notice, now granted this is 500,000, but what if it was 50 million? These numbers would be bigger, but what you see is in a declining market, it's better to average in. In a range-bound market, it's neutral. And when a market continually goes up, it's better to invest all at the same time. This all comes back to psychologically what's right for you and what you're comfortable with, not sort of what I say, but what the data says. It really doesn't matter. Because 80% of the time the markets are going up, 20% of the time the markets are steadily declining. And so those are just sort of the food for thought around that. So let's move into, we'll go into financial professionals, and let me just kind of go through that quickly, and then we'll bring up our first guest. So how do you look at these guys? There's all kinds of different professionals. How do you evaluate best practices? Who's the right guy? What questions do I ask? Very, very confusing. It's like you're interviewing a car mechanic and you don't know anything about a car. So I'm going to try to give you some clues and then walk you through some ways to do that. So there's various titles. There's investment advisors, financial consultants, wealth advisors, stockbrokers. We don't really hear stockbrokers anymore. That's somewhat of a nasty word. Then you got the discount guys. They don't really call them discount guys anymore. And then you've got relationship managers. So the big question mark is, so who do you go to? So we're going to really try to start to sift through that. Well, it's really this blank card where you identify who you are and what kind of investor are you and what your needs are, and then finding that appropriate craftsman, appropriate journeyman firm that matches what you need to what it is that they do. So this is what we do. So one of the things, we like to have this, we did this at the beginning of the class and we're going to do it quickly here, is we like you to have, to take out a piece of paper. So if you got something close to you, grab a piece of paper and a pen. And if you remember, we did this for your level of competency in the beginning of the program. Now what I want you to do is I want you to look at this a little different. And I want you to say, okay, what level of, how would you rate your current team, your current advisory team in these different areas? So take that piece of paper out, and it's just a pure 1 to 10. 10 is rock star, 1% is he's stealing money from me, and anything below 5 is I probably need to be looking for another guy. Don't have the right level. So how about wealth management plan? So quickly, 1 to 10, how do you think your advisor is implementing your wealth management plan? And that's an all-encompassing plan that encompasses many different areas. And then just your wealth advisor. How do you feel about your central point of contact? There's many firms that are big, and there's a senior advisor, a junior advisor, and a novice advisor. And so who do you deal with, and who do you interact with, and who's physically making decisions inside your investment portfolio? How about the performance management and reporting? Do you understand what your performance reports are? Do you understand the key variables of your allocation versus your target, your performance versus your benchmark, and then your cash flow versus your allocation? Do you feel like you have a complete understanding of what you're doing on a regular basis, a quarterly basis, a semi-annual basis, and not less than an annual basis? So write that as a 1 to 10. What's that rating? What about the estate and gift plan area? How do you feel about those areas? 1 to 10. Banking and lending. What's happening around your mortgages, your lending strategies, high interest debt, low interest debt. Andrew talked a lot about using their amortized loan structure inside their real estate portfolio. How about your CPA and your tax people? Do you have a CPA? Do you have a tax person? Do you have a tax attorney? Is your advisor integrated with those? Are there things that have been missed? Do you just not know? If you just had the same guy that did your taxes early on, are you in a different wealth bracket? Have you outgrown your particular advisory team based on a transaction or based on need? So just because you had legacy advisors doesn't mean those are the advisors that you need if your economic situation changes pretty dramatically. How about the family mission statement? It's ever so critical, because the money management piece of allocating asset, like Andrew talks about, is a relatively simple game if you devote the necessary time to educate yourself and establish systems and processes and structure. But if you don't get the family right, if you don't get the the values and the mission, about the why of what you're doing, I've seen money destroy families. Like, why did he get his college educated paid for and my kids didn't? He got a bigger home, I didn't get that big a home. Families are not discussing the wealth. There's not trust amongst different generations, and the lack of trust breeds a whole bunch of things that have nothing to do with the money and have more to do with the family history. So 1 to 10, where's your team with that? The family business. Your money is your family business. Where are you relative to that? How do you feel about who's running the family business? And number 9, your investment policy statement. And that, we haven't got there yet. We're going to talk a little bit about that later tonight if we end up with time. But an investment policy statement is what endowments and fiduciaries and high net worth families use to really memorialize what it is that they're doing. So does your advisor use an IPS? You know, that's a 1 to 10. And do you understand it? Is it complicated? Is it simple? You know, is it effective? And then 10, asset protection. What are the asset protection strategies? So these are kind of the 1 through 10. And, you know, really this is something that you now can add up your score. And you can kind of look at where you have holes. Like if all of a sudden you went to the doctor and you needed surgery, you needed something done. You know, what level of competency would you look for if you needed your heart worked on or your hip replaced? I talked about a story. I had hip surgery. I went to the guy that I thought was the best, and wouldn't have went to anybody else. And so when it comes to your financial team, you got to ask yourself these very, very important questions, because what happens is, and this is a psychological phenomenon, and I'm going to challenge anybody that's listening to me live or sees it on a replay, is clients are oftentimes very reluctant to fire a friend, even though they know structurally that professional no longer suits their needs. It's one of the reasons we overlay a well-run business on top of the investment plan. So if you're the CEO of a company and you've got a division manager that's not meeting their particular benchmarks, what would you do? You'd sit them down. You'd say, okay, here's your benchmarks. Here's what you need to do. Here's what you need to change. Now go out and do it. If that continually underperforms, then there's going to be consequences, and eventually you're going to replace that person. It's the same thing with financial professionals. What happens inside the wealth management space is people just don't understand all these different issues, and the wealth space is so much of a fog. You don't really know what's really happening inside of your accounts. You know you're up. Are you up with the mark? Last year the market was up 30%. You know, how did you do? Were you up 28? Were you up 24? You know, your money was up. You're saying, okay, we had a good year, we're up 25. But if the market was up 32 and you're up 25, you underperformed by 7%. And so you didn't get everything that you were supposed to get depending upon what that particular plan was. So this is something that's always been curious for me. When I see people defend their advisors that they know, and I know, no longer fit the family objective. So this exercise, I think, is something where you got to look in the mirror and have a heart-to-heart and see whether or not they continue to serve you. So with that said, we're going to take a short little 3-minute, and then we're going to start our advisor interviews. It's going to be lots of fun.